Hi, my name is Tosin Vitoye. I'm a property investor, and over the last 2 years, my partner and I have successfully grown our property business to over £1 million by buying, renovating, and renting properties using investor funds. And on this channel, we are documenting our journey to financial freedom. In this video, I'll be telling you in the context of property investing what capital gains tax is, when you're required to pay capital gains tax, and ultimately how to avoid paying capital gains tax. Let's get into it. Before we start, I should say, if you're here for financial advice, I suggest you leave now, because I will not be held accountable for your financial decisions. But I can provide information and you can use that as you see fit. So, information, not advice. Capital gains tax. Capital gains tax is a tax on any profit or gain above £6,000 that you make when you sell or dispose of something, in this case, property, that has increased in value during the period which you owned it. It's worth mentioning that you only pay capital gains tax on the gain or profit that you make, not the amount you receive on the sale of the property. I know I said the profit or gain that you make when you sell or dispose of a property. Just for clarity, I would like to explain what disposing of means. So disposing of can mean or means selling off your property, gifting your property, or trading your property. So if you exchange your property as a form of payment for something else. So if you just exchanged it as barter, trade by barter, for example, that counts as disposing of. And getting compensation on your property or for your property also counts as disposing of. So if you got like an insurance payout on your property, that counts as disposing of. So you'll be paying capital gains tax on that compensation, provided you made any gain on the value of the property when you acquired it and when you got compensated for it. So for a simple example of capital gains tax, if you buy a property for say £100,000 and then you hold that property for a period of 5 years or however long you hold the property for, and then you come to sell it for the sum of £200,000, the capital gain on that property will be the selling price minus the purchase price. In this case, that's £200,000 minus £100,000. So your gain on this property now is £100,000. So you'll be paying capital gains tax on that gain, which is called the taxable gain. That's a simple example. So now for a proper example, or should I say a proper illustration, so you understand it properly. Using the same figures, the same property. So you buy this property for £100,000. You hold this property for however long you hold the property for, and then you come to sell this property for £200,000. In my previous example, it was simply the sale price minus the purchase price. But if you wanted to properly calculate your capital gain, your equation will be the selling price minus the cost price. And the cost price here in the context of property will be your purchase price, your refurb cost, if you've done any refurb on that property, your stamp duty. At the time when you bought the house, you paid stamp duty, your solicitor's costs at the point of purchase and at the point of selling. That adds up to your cost price, and also your estate agent fees, because obviously when you're selling the house, you need an estate agent. So all of this makes up your cost price, and all of this being, again, your stamp duty, your purchase price, your refurb cost if you had any refurb on the property, your solicitor's fees, and your estate agent fees. These are expenses that you can write up against the capital gains. So if when you have your total cost price, you then deduct that from your sale price. So going back to our numbers now, you bought this house for £100,000 and then you're selling it for £200,000. And our equation, our formula was selling price minus your cost price. And we've just said that your cost price consists of your refurb cost, your stamp duty. So let's just say your refurb cost was £20,000 and the accumulated cost of your solicitor, your estate agent, your stamp duty was £5,000. So that means 20,000 for refurb, 5,000 for all else, plus your purchase price. This is coming to 125,000. So you deduct 125,000 from 200,000, and then you get your taxable gain, which in this case will be £75,000. So you are only expected to pay capital gains tax on £75,000. Now let's hold it here for a minute, because in every tax year you get something called annual tax-free allowance on capital gains. And in the 2024-2025 calendar year, the annual tax-free allowance amount is £3,000 and 1,500 for a trust. Now, how much capital gains tax do you pay? You're probably asking. So the amount you pay as capital gains tax, or the rate of your capital gains tax, depends on various factors such as your income or the size or volume of capital gain on this property. Basic rate taxpayers would typically pay 18% on their taxable gains, and higher and additional tax rate payers would pay 24%. Now, before I go as far as to flesh out how you calculate your capital gains tax or the rates that's payable, I believe we should have a quick refresher on the income tax band. I'm sure some of us know this at the back of our minds, but just a quick refresher. As you can see there in this screen grab, we're all familiar with the personal allowance, which is up to £12,570. So anything below this or anything at this amount is not taxed. It's a 0% tax rate. And then the basic rate, as you can see there, is 20%, provided you fall within the figures there. The higher rate is 40% if you fall within that £50,000 range to £125,000 range. And additional rate is 45%. And some of us might not be aware, but the income tax bands are different if you live in Scotland. And on here you can see the figures. The personal allowance is the same as in England. It's up to £12,570 at 0%. In Scotland, you have a few additional bands there. You have starter rates, you have intermediate rate, and you have advanced rate and top rate. But you can see the numbers on there. So now going back to how much capital gains tax you pay, or the rate of capital gains tax that you pay. If you are a basic rate taxpayer, the rate of capital gains tax that you will pay will depend on the size of the capital gain and your taxable income. So let's work this out. So first, there are two calculations to this. The first calculation, work out your taxable income, which is your income minus your personal allowance and any other tax reliefs that you might be entitled to. That's the one half of it. And then the other half will be, you look at your capital gain and then you deduct your annual capital gains tax-free allowance. For this calendar year, it is 3,000. So you deduct that from your capital gains, and that's the other half of it. So now the result of these two halves, you combine these figures, and the amount, if it still falls within the basic rate tax band, then you pay 18%. And if it falls above it, then you'll be paying the higher rate capital gains tax rate. So to now touch on the higher and additional tax rate band, the calculation is pretty much the same, but the rates are different. So you take into account your taxable income, which is your income minus your personal allowance and any other tax reliefs that you might be entitled to. And then you look at your capital gains, and then you deduct your annual capital gains tax-free allowance from that figure. So the results of these two calculations, you combine the amount, and if the amount is above your basic rate, which takes you into the higher tax rate or additional tax rate, then you'll be paying the rate of 24%. For example, your taxable income, which is your income minus your personal allowance and any other tax relief you might be entitled to, is equals to £20,000. And then your capital gains for that year is equals to 12,000, I don't know, 12,600, for example, because figures are not always rounded. So let's just go with 12,600. So what happens here is you have your taxable income here, which we've said is £20,000, and then your capital gains is 12,600. So then you deduct your annual capital gains tax-free allowance of 3,000 from 12,600, which then gives you 9,600. So you add in your 20,000, which is your taxable income, plus your taxable gains, which is 9,600. As you remember, that's 12,600 minus the deductible annual tax-free allowance of 3,000, which brings us to 9,600. So adding these two figures together gives us 29,600. This combined amount falls within the basic rate tax band. So here in this case, you'll be paying 18%. So now to give an example of a higher rate or additional rate where you pay 24%, this will look like your income, for example, is, let's maintain that at £20,000. Remember our first illustration of buying and selling a house where our taxable gain was £75,000, because obviously we bought the house for 100, sold it for 200, and we took out our cost of refurb and stamp duty and all of that. That gave us 125. So we took out the 125 from £200,000 to land at a taxable gain figure of £75,000. So we bring this £75,000 down to our current illustration, and we don't forget to take out the annual tax-free allowance of 3,000. So you take out 3,000 from £75,000, you're left with £72,000. So £72,000 plus your taxable income, which is £20,000, brings us to £92,000. And this figure is well above the basic rate tax band. So you definitely at this figure will be paying 24%. And now for the juicy bit that everyone has been waiting for, I am sure, which is how to avoid paying capital gains tax. So I have done the job for you. I have looked through the books of the government and I have found these ways to avoid or reduce your capital gains tax. Number one is you do not usually pay tax on gifts to your husband, your wife, civil partner, or a charity. 2, you only pay capital gains tax on any gains that is above your annual tax-free allowance. So if your capital gains is not more than 3,000, for example, that's for this year. If your capital gains is not more than 3,000, you do not pay tax on that. 3, you can report losses to HMRC in order to reduce your tax gains for that year. You can carry forward losses of previous years that you haven't used and bring that forward to the current year to reduce your taxable gains, potentially reduce it below your annual tax-free allowance, and then you don't pay capital gains on that. 4, remortgaging your property. If you have a property and you're considering selling it off, and you're not gifting it to your husband or your wife, and one of your options is to sell that property, you will pay capital gains tax on any gains on that property from when you bought it to when you're thinking of selling it off. Whatever capital gain there is on that property, you will pay tax on it. But another option you can consider is to remortgage that property, which means taking out a loan on that property, in which case you do not pay capital gains on a loan because you haven't disposed of the property. Ultimately, 5, transferring equity or your property to your child, sibling, or another person. Usually, you will pay capital gains tax when you transfer equity or your property to anyone else, but you might be entitled to principal private residence relief if you are transferring your property that is or has been your main residence. So you should probably check this with a financial advisor. And that's it on capital gains tax. When you're required to pay capital gains tax, what capital gains tax is, and the different rates of capital gains tax, and ultimately how to avoid or reduce capital gains tax. This has been good. Please feel free to leave a comment if there's any part of this video that you do not understand, and I'll do my best to clarify it in the comment section, or I might just make an entire video to explain it further. And feel free to watch any of the videos on your screen currently. Thank you very much, and I'll see you in the next one.